Disclaimer. All contents, ideas, opinions and information shared or implied herein are for informational and educational purposes only. Hello everybody. Welcome to Sunny the Eggman YouTube channel. In this video, we will be revealing on the fundamental analysis for Suntec Reit, its strategic review and recent financial results. Before starting, please help to share and subscribe this channel, as your support is our biggest motivation to continue on producing quality contents. Suntec Reit, SGX trading code T82U, is the first composite REIT listed in Singapore since December 2004. It's managed by an external manager, Era Trust Management, Suntec Limited, a wholly owned subsidiary of Era Asset Management Limited. Era is the largest real estate manager in Asia Pacific, which managed approximately $95 billion in gross assets. As of the 30th of June 2021, Suntec Reit portfolio includes office and/or retail properties across Singapore, Australia and United Kingdom, which comprises total net lettable area of 5.5 million square feet, valued at 11.5 billion Singapore dollars. The Minster Building, Grade A office building in the heart of City of London, is one of the newly acquired asset in 2021, followed by the divested interest in 9 Penang Road, Singapore. Its market capitalization is approximately 4.2 billion Singapore dollars currently. Firstly, we will be looking at Suntec Reit financial statements for fundamental analysis. The revenue for Suntec Reit is increasing from 329 million Singapore dollars in 2016 to 367 million Singapore dollars in 2019. In 2020, it experienced a sharp drop by 14%, from 367 million Singapore dollars in 2019 to 315 million Singapore dollars in 2020. Also, its net property income decreased by 15%, from 236 million Singapore dollars in 2019 to 200 million Singapore dollars in 2020. This is mainly due to grant of rental support to retail tenants in Suntec City, lower occupancy and marketing communication revenue from Suntec City, as well as decrease in events, conventions and exhibitions revenue during the pandemic. Nonetheless, the impact is partially offset by contributions from 55 Curry Street and 21 Harris Street acquired in 2019 and 2020, along with the completed development of Olderfeet, 477 Collins Street in 2020. Next, the distribution per unit of this REIT is also decreasing from 10 cents in 2017 to 7 cents in 2020. In terms of NAV, it is also slightly decreased by 3%, from 2 Singapore dollars and 13 cents in 2019 to 2 Singapore dollars and 6 cents in 2020. Investment properties are valued at 7.3 billion Singapore dollars in 2020, which shows an increase of 6% from 2019. However, the interest-bearing borrowings for Suntec Reit increased from 3.6 billion Singapore dollars in 2019 to 4.8 billion Singapore dollars in 2020. This resulted in the aggregate leverage ratio of 44.3% as at the 31st of December 2020, which is just 6% below the group's aggregate leverage limit. The Property Fund's appendix states that the total borrowings and deferred payments of a property fund should not exceed 50% of the fund's deposited property. It's relatively worrying, especially when the free cash flow is at negative 101 million Singapore dollars in 2020, as compared to positive 89 million Singapore dollars in 2019. Now we will be revealing on the strategic review on this REIT stock. The stock price is trading at 1 Singapore dollar and 44 cents as of the 10th of September 2021, which has dropped by approximately 6% as compared to 1 year ago. It is currently trading below its NAV of 2 Singapore dollars and 6 cents as of the 31st of December 2020. Also, if we look into the stock price trend in 5 years' time, Suntec Reit is showing an observable drop from 1 Singapore dollar and 73 cents in September 2016 to 1 Singapore dollar and 44 cents in September 2021, by 17%. Its 5 years lowest is recorded at 1 Singapore dollar and 11 cents on the 23rd of March 2020, during the beginning stage of COVID-19 pandemic in Singapore. This is mainly due to drop of rental performance for office and retails resulted from challenging business conditions amid COVID-19 outbreak. Tenants have heightened cost consciousness to rationalize their space usage. A report from Knight Frank as of Q4 2020 shows the decrease in average monthly gross rental in prime spaces for Singapore. Next, in terms of distribution yield, it remains at an average of 5.4% over the past 5 years, except in 2020, it drops to 4.9%. Lastly, let's look at Suntec Reit unaudited financial results for first half ended the 30th of June 2021. Revenue improved by 11.6% from first half 2020 to first half 2021, mainly due to contribution from 21 Harris Street, with effect from April 2020, amounted to 7.3 million Singapore dollars in contribution from 477 Collins Street, with effect from August 2020, amounted to 12.5 million Singapore dollars. In terms of net property income and JV income, it is increased by 28% year-on-year comparison, mainly due to 28.8% increase in office sector, 18.1% increase in retail sector, offset by 34.1% decrease in Suntec Convention. Next, Suntec Reit also shows an increase of 26.1% in distribution per unit, from 3.3 cents in first half 2020 to 4.2 cents in first half 2021. For NAV, it was the same at 2 Singapore dollars and 6 cents as of the 30th of June 2021, compared to the 31st of December 2020. The key financial indicators for first half 2021 is relatively similar, except the slight decrease in aggregate leverage ratio. As of the 30th of June 2021, the portfolio occupancy rate for Singapore office overall is 95%, decrease from 96.6% in the 31st of December 2020. Nonetheless, the occupancy rate in Australia office overall, 93.9%, and UK, 100%, are consistent with the 31st of December 2020. Based on the overall financial results, it is clearly indicated that Suntec Reit is significantly impacted by COVID-19 pandemic, mainly due to huge challenges faced by its tenants for office and retail sectors. Even though management had taken proactive measure by divesting 9 Penang Road and Suntec City office strata units, the revenue, net property income and distribution per unit are still dropping in 2020. To add on, Suntec Reit is presenting a weak balance sheet results in 2020 as well as first half of 2021. Aggregate leverage ratio of 44.3% shows that it's highly leveraged on borrowings. Although the management is optimistic that the outlook for Singapore, Australia and UK remain positive as some COVID-19 restrictions lifted after vaccinations, the overall economy still remains uncertain. For example, the tenant sales for Singapore seem starting to recover in January 2021, but experienced sudden drop in May and June 2021 due to heightened alert imposed by government. Hence, the recovery of COVID-19 impact on tenants remains challenging and it is not expected to return to pre-pandemic level anytime soon. The annualized return for this REIT based on historical data is only approximately 2% for investment more than 5 years, mainly due to return from distribution received. It is advisable to observe on their balance sheet performance and future growth prospect before investing in Suntec Reit. Hope you can have some valuable insights on Suntec Reit after watching this video. Do comment and share with us your thoughts on the above points. Stay tuned and remember to share, like and subscribe our channel. I'm Sunny the Eggman. Goodbye.